The average American has $0 saved. That's the headline you've probably seen. And it sounds almost unbelievable. How can that be true in the richest country in the world? Here's the strange part. It's not exactly a lie, but it's not exactly the truth either. And the real story hiding inside that statistic is something that could change the way you think about money for the rest of your life. Let's start with a number that sounds reassuring. According to the Federal Reserve, the average American holds about $62,410 in checking and savings accounts combined. $62,000. That doesn't sound like zero at all, but averages lie. They lie in a very specific way. Imagine 10 people standing in a room. 9 of them have $1,000 in the bank. One person, a billionaire, walks in. Suddenly, the average person in that room has over $100 million. Nothing about the 9 regular people changed. But the math says everyone is suddenly rich. This is exactly what happens with national savings statistics. A small number of extremely wealthy households pull the average so high that it stops describing anyone normal at all. So economists use a different number. It's called the median. The median doesn't ask what the total adds up to. It asks what the person right in the middle actually has. No billionaires allowed to skew the picture. And the median tells a completely different story. The median American household holds about $8,000 in checking and savings combined. Not $62,000. $8,000. And if we narrow it down specifically to emergency savings, the kind of money set aside just in case something goes wrong, the median balance drops even further. According to a 2025 survey by Empower, the median American emergency fund is just $600. $600. That's not a safety net. That's barely a seatbelt. Let's make this real. According to the Federal Reserve's most recent survey of household economics, 12% of Americans could not cover a $400 emergency by any means at all. Not credit, not cash, not borrowing from family, nothing. Another large share could only cover it by putting it on a credit card, one they might not be able to pay off right away. Think about what counts as a $400 emergency. A car repair, a trip to urgent care, a broken laptop you need for work. These aren't rare disasters, they're just Tuesday. And here's a statistic that should stop you in your tracks. Northwestern Mutual's research found that 42% of Americans have no personal savings at all. Not low savings, none. So how does this actually happen to people who have steady jobs, who aren't reckless, who think of themselves as responsible? It starts with a simple, invisible habit. Most people treat saving as whatever is left over at the end of the month. Rent gets paid first. Groceries get paid. Insurance, gas, subscriptions, all of it gets paid. And only after every single expense is covered does a person think about saving. The problem is, there's almost never anything left over. Expenses have a strange ability to expand and fill every available dollar. If you have $100 extra this month, something will find a way to spend it. A nice dinner, a small upgrade, a treat-yourself purchase that felt harmless in the moment. None of these purchases are evil on their own, but added together, they quietly consume the exact margin that could have become a financial cushion. Now picture what happens when an actual emergency hits someone with zero savings. A car breaks down. The repair costs $1,200. With no savings to draw from, the bill goes on a credit card. The average credit card interest rate in recent years has been well above 20%. That bill doesn't just cost $1,200 anymore. It costs more every single month it isn't paid off. And here's the part most people don't realize. That new monthly credit card payment becomes a permanent fixture in the budget. It's not a one-time setback. It's a recurring cost that now competes with the person's ability to save going forward. One emergency, with no buffer, can quietly make saving harder for years. This is the trap. Not laziness, not stupidity. Just an invisible system with no buffer built in, repeating itself every time life throws something unexpected at it. But here's where the story gets hopeful. Because the data also shows something most people never hear about. In April of 2020, during the early shock of the pandemic, something remarkable happened. The U.S. personal savings rate hit 33.8%, the highest level ever recorded. For a brief moment, Americans were saving over a third of their income. Why does this matter? Because it proves something important. The capacity to save was never the problem. People didn't suddenly become financially brilliant overnight. What changed is that spending was forced to slow down, and saving stopped being optional. That tells us the real obstacle isn't ability, it's structure. So, what actually works? Not motivation, not willpower. Structure. Research from Bankrate found that people who automate their savings, meaning the money moves to a separate account automatically before they ever see it, consistently build larger financial cushions than people who try to save manually, no matter how disciplined they think they are. This makes sense once you understand a simple psychological pattern. It's called mental accounting. Money sitting in your checking account feels available, spendable, fair game. But the exact same amount of money, once it's automatically moved into a separate savings account, feels off-limits, untouchable. Already spent, in a sense, just spent on your future instead of your present. You're not relying on discipline anymore. You're relying on a system that makes the decision for you, once, instead of every single day. There's another number worth knowing. Research from Vanguard found that crossing a savings threshold of around $2,000 is linked to a noticeably higher sense of financial well-being. Not $20,000, not 6 months of expenses. $2,000. This is one of the most important and most overlooked facts in personal finance. The first bit of savings matters far more than people expect. It's the difference between panic and calm the next time something breaks. So if you're starting from zero, here is the order that actually works. Step 1. Stop aiming for the textbook advice of 3 to 6 months of expenses right away. That number is the long-term goal, not the starting line. Aiming for it too early is exactly why so many people give up before they even begin. Step 2. Set a small, specific first target, $500 or $1,000, enough to cover the most common emergencies without panic. Step 3. Open a separate account for this money. Ideally, a high-yield savings account, which pays significantly more interest than a typical bank account, often 4 times higher or more, with zero added risk to your money. Step 4. Automate a transfer on the same day your paycheck arrives, even if it's a small amount. The amount matters less than the fact that it happens automatically every single time, without you having to decide. Step 5. Once you hit your first goal, raise the target. 1 month of expenses, then 3, then 6. Each stage gets easier because you're no longer starting from zero, and you've already proven to yourself that the system works. There's one more pattern worth understanding, because it explains why some people seem to save easily while others struggle no matter how hard they try. Federal Reserve data shows that people with a bachelor's degree have a median savings balance of about $23,700. People with some college experience but no degree have a median balance of about $5,200. That's more than 4 times the difference. This isn't about who tries harder. It's largely about access to higher income. Saving is easier when there's more room in the budget to begin with. If you're struggling to save, despite doing everything right, it doesn't necessarily mean you're failing. It might mean the income side of the equation needs attention too, not just the spending side. So let's come back to where we started. The average American has $62,000 saved. The typical American has about $8,000. And the typical American's actual emergency fund is just $600. All three of those statements are true at the same time. They're just describing different things. And once you understand the difference, you stop comparing yourself to a misleading average, and you start looking at the number that actually matters, your own number, and the system you're building to grow it. Because here's the real takeaway. The problem was never that Americans can't save. 2020 proved that wrong. The problem is that saving has been left to chance, treated as leftovers instead of a plan. Fix the system, even in a small way, and the $600 emergency fund stops being your story. If this helped you see your own finances a little differently, that's exactly what this channel is here for. More of this is coming.